Ladies and gentlemen, in today's video, I will show you how to determine the fair market value of a company as a function of the directions of key variables. In today's video, we will use my favorite model, the one that I love, the residual value model, to determine the value of a stock that I believe is currently significantly undervalued. The name of the company, of the stock itself, is GAN Limited. It is important to remember that according to the residual value model, the share price of a company is equal to the current book value per share plus the present value of residual value. The residual value is simply the net income minus the previous year book value per share multiplied by the cost of equity. So our key variables in the residual value model will be one, the net income that we will get by forecasting the income statement. The cost of equity, I love to use two different value for the cost of equity. My investment horizon is 10 years, so we're going to determine the cost of equity for the first period, which goes from 2022 to 2030, and the cost of equity for the second period, which goes from 2030 to the foreseeable future, and the long-term growth rate that will help us determine the fair market value of the company in year 2030. For those of you not familiar with my work, welcome to the analyst. We are going to use a very dynamic model as we did in our first video. And what we need to do is to forecast key variables. Here, we are going to set different directions that the key variable can take. And for the income statement, we are talking about the revenue growth rate. I will take the revenue growth rate for the income statement from 10% to about 58%. It is important to stress that this company grew at the 3-year compounded annual growth rate of about 107%. And once we have determined the first line of the income statement, which is the revenue, using our growth rate, it is important to get the remaining line of the income statement. It is important to stress that each line of the income statement bears a different relationship to the revenue. For instance, the cost of revenue usually have the strongest relationship with the revenue, and the remaining line requires an adjustment. And for this company particularly, the cost related to product and technology, the cost related to general and administrative, the cost related to impairment will need to adjust over time and represent and have a lesser importance relative to revenue has moved into the future for this company to be profitable. We're going to do the same when we forecast the remaining line. This is what we get for our income statement. Now, the second variable that we need here is the book value of the company. The book value of the company, for the forecast of book value of the company, we are going to consider that the main change in the book value of the company will arise from the net income, from the change in the return earning. And it is pretty simple. Once the income statement has been forecasted, we have our ending value of the book value per share. It is important to stress that the revenue that we will determine, or the first line of the income statement, will be a function of the growth rate in revenue that we have chosen. We have multiple that we have chosen from 10% to about 58%. If I go back to the model, I go to fair value and I change, for instance, the revenue growth rate to about, let's say, 10%. This is what we are going to get in terms of revenue from 2022 to about 2030. So the next variable that we need to determine for this exercise are obviously the cost of equity for the first period, 2022 to 2030, and the second period from 2030 to the foreseeable future. For the first period, we have determined the cost of equity to be about 13.5%, for the second period to be about 9.78%, and the long-term growth rate to be about 3% in line of the OECD forecast of the economic growth. However, because we consider this to be key variable, we will have to choose or to kind of assess the value of GAN Limited, of the stock of GAN Limited, depending upon the different value of the cost of equity and revenue growth rate. So now we can go back to the fair market value. This is actually a very good approach because it helps you to determine the fair market value of a company or to form a fair market value of to form an opinion regarding the fair market value of a company depending upon the direction of key variable, because it is usually function of the direction of key variable. For instance, when we take the self-growth rate to be about 10% with the cost structure that we have determined, we notice that all the value in reds indicates value that are currently less than the current market value of a company. So for a self-growth rate of about 10%, it indicates that this company is currently overvalued. Now, when we go to the revenue growth rate of about 20%, now we see that this table right here, which represent the possible value of the share price of a company, is dominated by the green. The green represent value of the share price that are currently greater than the current market value of the company. For instance, for the cost of equity, for cost of equity for the first period to be about 9.67%, and for the second period to be about 8.78%, the share price of the company should be about $34.58. And you can do the same. You can do the same using other values. Now, when we change the self-growth or the revenue growth to be about 30%, now you can see that the proportion represented by value superior to the current market value of the company increased to more than, I would say, 70%. And you can do the same going till, I will say, 58%. 58%, there is only one value currently lesser than the current market value of the company. We can go to 15%, and we can see that for this company using the current operational cost structure that has been used in this model, we can see that we will need this company to generate over that investment horizon choosing a revenue growth rate of about, let's say, 20 to 25% to feel confident about our valuation. So I will pay a particular attention to the revenue growth rate of this company. It is also very important to stress that all this will depend on how the operational costs change. I expect the operational cost to go down in the future because this current structure is unsustainable. I mean, in terms of relative to the revenue that the company generates. And for a company that has been growing at a 3-year compounded average growth rate, a revenue of about 107%, I believe that 25% growth rate or even 30% growth rate is achievable. That leads me to conclude that this company is currently significantly undervalued and should be trading around $15 to $23. 15 has been found using the comparative analysis model that I usually like to use. I have built my own valuation model, which is a comparative analysis model, and it gives me about $15. And using this one, I found about $23 to be a good price for this company. So this is another case of undervaluation. Instead of wasting your resources investing in expensive stocks, you can buy stock for a company like GAN Limited. I will tell you, investing $100 to buy the share of a company is a lot. It's a lot. Microsoft went public at the share price of around, I would say the reference price was about 21%. So this is what I feel about this company. I hope you enjoyed this video. I obviously want to hear from you regarding the assumption that I've used. I also want to hear what you think about the value of this company. And the question that I always ask is, what is your investment horizon and what are the expectations that support your valuation of this company? So I hope you enjoyed this video. If that's the case, do not forget to like and see you next time.